Welcome to the BarthCalderon Boss Series. Today's topic is Know Your Numbers. My name is Bill Black. I've been a business planner since 1983. I'm a certified exit planner, and I'm founder and host of the Exit Coach radio show and podcast. And I also moderate quite a few Fridays with Vistage webinars. About our Boss Series, or Business Owner Situations and Solutions, we've talked to over 500 CEO peer groups over the years. That's about 5,000 plus CEOs. And I personally have interviewed over 1,000 advisors on my radio show. And we find that most business owners are too busy working to plan their futures. And we want to help our clients take more control and become better business owners. So today's topic is Know Your Numbers. Why? Because we feel that to create a valuable, sustainable business, you need to know certain numbers. And we're going to cover 7 important ratios that we think you should know. And we're also going to discuss the 2 valuation numbers you should know in today's presentation. You know, it's been said that doctors, when they're developing world, measure their progress not by the aggregate number of children who die in childbirth, but by the infant mortality rate, a ratio of the number of births to deaths. Similarly, baseball's leadoff batters measure their on-base percentage, the number of times they get on base as a percentage of the number of times they get a chance to try. Acquirers also like tracking ratios, and the more ratios you can provide a potential buyer, the more comfortable they will get with the idea of buying your business. Better than the blunt measuring stick of an aggregate number, a ratio expresses the relationship between 2 numbers, which gives them their power. If you're planning to sell your company one day, here's a list of 7 ratios to start tracking in your business now. First, employees per square foot. By calculating the numbers of square feet of office space you rent and dividing it by the number of employees you have, you can judge how efficiently you have designed your space. Commercial real estate agents use a general rule of 175 to 250 square feet of usable office space per employee. Second is your ratio of promoters and detractors. Fred Reichheld and his colleagues at Bain & Company and Satmetrics developed a Net Promoter Score methodology, which is based around asking customers a single question that's predictive of both repurchase and referral. Here's how it works. You survey your customers and ask them the question on a scale of 1 to 10, how likely are you to recommend your company to a friend or colleague? Figure out what percentage of the people surveyed give you a 9 or 10 and label that your ratio of promoters. Calculate your ratio of detractors by figuring out the percentage of people surveyed who give you a 0 to 6 score. Then calculate your Net Promoter Score by subtracting your percentage of detractors from your percentage of promoters. The average company in the United States has a Net Promoter Score between 10 and 15%. According to Satmetrics' 2011 study, the U.S. companies with the highest Net Promoter Score are USAA Banking at 87%, Trader Joe's 82%, Costco at 77%, Apple at 72%, Amazon at 70%. Next is your sales per square foot. By measuring your annual sales per square foot, you can get a sense of how efficiently you're translating your real estate into sales. Most industry associations have a benchmark. For example, annual sales per square foot for a respectable retailer might be $300. With real estate usually ranking just behind payroll as a business's largest expenses, the more sales you can generate per square foot of real estate, the more profitable you are likely to be. Specialty food retailer Trader Joe's ranks among companies with the highest sales per square foot. Business Week estimates it at $1,750, more than double that of Whole Foods. Next is your revenue per employee. Payroll is the #1 expense of most businesses, which explains why maximizing your revenue per employee can translate quickly to the bottom line. In a 2010 report, Business Insider estimated that Craigslist enjoys one of the highest revenue per employee ratios at $3,300,000 per employee, followed by Google at $1,190,000 per bum in a seat. Amazon was at 1,010,000, Facebook at 920,000, and eBay rounded out the top 5 at 530,000. Now, more traditional people-dependent businesses may struggle to surpass $100,000 per employee. Next is customers per account manager. How many customers do you ask your account managers to manage? Finding a balance can be tricky. Some bankers are forced to juggle more than 400 accounts and therefore don't know each of their customers, whereas some high-end wealth managers may have just 50 clients to stay in contact with. It's hard to say what the right ratio is because it's so highly dependent on your industry. Slowly increase your ratio of customers per account manager until you see the first signs of deterioration, slowing sales, a drop in customer satisfaction, etc. That's when you know you've probably pushed it a little too far. Number 6 is prospects per visitor. What proportion of your website's visitors opt in by giving you permission to email them in the future? Dr. Carl Blanks and Ben Jensen are the co-founders of Conversion Rate Experts, which advises companies like Google, Apple, and Sony how to convert more of their website traffic into customers. Dr. Blanks and Mr. Jessen state that there is no such thing as a typical opt-in rate because so much depends on the source of traffic. They recommend that rather than benchmarking yourself against a competitor, you benchmark yourself against yourself by carrying out tests to beat your site's current opt-in rate. Dr. Blanks and Mr. Jessen suggest that the easiest way of increasing opt-in rate is to reward visitors for submitting their email addresses by offering them a gift they'd find valuable. Information products such as online white papers, videos, and calculators make ideal gifts because their cost per unit can be almost zero. Using this technique and a few others, Conversion Rate Experts achieved a 66% increase in the prospects per visitor rate for SOS Worldwide, a broker of office space. And the 7th ratio we're talking about today is prospects to customers. Similar to prospects per visitor, another metric to keep an eye on is the efficiency with which you convert prospects, people who have opted in or expressed an interest in what you sell, into customers. Conversion Rate Experts Dr. Blanks and Mr. Jessen recommend you monitor the rate at which you are converting qualified prospects into customers and then carry out tests to identify factors that improve that ratio. Conversion Rate Experts more than doubled the revenues of SEObook.com, the leading community for search marketers, by converting many of SEObook's free subscribers into customers. Techniques that were found to be effective included, perhaps counterintuitively, restricting the number of places available, allowing easier comparison between SEObook and the alternatives, communicating the company's value proposition more effectively, and simplifying its sign-up process. The trick is to establish your benchmark and tinker until you can improve it. Acquirers have a healthy appetite for data. The more data you can give them in the ratio format they're used to examining, the more attractive your business will be in their eyes. In addition to these ratios, we find it's very, very important for you to know your current value of your business. Many business owners guess at the value of their business, and usually they're way off. We find that one of the reasons you need to know your value is so that you can understand what you need to do to grow the value, and that goes hand in hand with the second valuation you need to know, which is understanding and knowing your target value. This takes some financial planning to back into what your expenses will be into retirement, and what your income needs will be, and then to figure out what you need to do to fill in the gap that exists between the capital that you will have, the income that you will have, and the income that you will need, and then backing into a pre-tax number so that you can understand what your business needs to sell for. We find business owners that know these two numbers, what your business is worth now and what your target value is, have clear defined goals and understand what they need to do as they move towards growing the value of the business towards their eventual exit. The Boss Series is a series of short videos, articles, and checklists to help you tackle several of the top issues that we hear from business owners on a regular basis. We have new content every week, and next week we'll be talking about assembling and controlling your advisor team. Thank you so much for joining us today with BarthCalderon, where we believe in planning today for all of your tomorrows.